This is TreppWire Week in Review for week ending February 3rd, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, the Fed decision, earnings, and jobs are the focus. As expected, the Fed lifted rates 0.25 percentage point, and signs so far point to a still tight labor market, with job openings increasing to 11 million and quits still above 4 million. A bunch of other data for investors to chew on. Housing prices declined, manufacturing dropped, and consumer confidence slipped. Manus, Fed Chair Powell walked a very careful line this week with his comments, but stocks rallied afterward. What was that all about?
It's funny, I don't really speak Powell. I barely speak English, as my kids know very well. I was watching that presser after the Fed announcement, after the hike was revealed. And I find this happens a lot, where I'm watching and I'm hearing hawkishness, or at least partial hawkishness, and yet the market is hearing something entirely different, right? I'm hearing we still have work to do. There'll probably be more rate hikes in the future. We haven't seen, enough declines yet in inflation. And yet the market took his remarks as extraordinarily dovish and took off. So as I said, I don't speak Powell. It doesn't really make sense to me. All I know is that there's three, trends, if you will, this week that I thought were interesting and in some ways contradictory. The first was that we saw economic data that was kind of telling two different stories. Some that was very bearish on the US economy, or at least on the inflation front, and some that was very, very bullish. We also saw a huge run up in unloved stocks this week. Things that were really beaten up in 2022 rallied enormously this week. At one point today, the NASDAQ was up almost 4%, driven largely by Facebook. And then the third part of it is, earnings have been a very, very mixed bag. So I know that the market was risk on this week. The indexes had risen sharply. I think the NASDAQ is now up 15 or 16% year to date in 32 days. And so that's the vibe of the market. But I do think when you scratch beneath the surface, there's a lot more to uncover.
Yeah, I agree with you, man. It's almost like watching those old movies, where the actor's lips moving, but the commentary doesn't quite line up with what they're saying. I think that's the scene when Powell's talking and the market's reacting in a different way. Because if you actually, parse through what he said, not only was it like unanimous approval of the 25 basis point increase, but then Powell said he doesn't expect the Fed to cut rates this year. And he actually implied, or stated a couple more hikes are likely. So to your point, I'm not sure exactly, maybe that is bullish. I don't know. I mean, it's the 8th increase in the past year. The pace in which they've increased rates is faster than any other time during the tightening series. So, I mean, it's interesting to see the market react the way that it is. Some additional, macro news this week. We've touched on this a little bit over the last couple of months. The housing market. Prices continue to decline, but it's interesting. A lot of people are saying the worst is yet to come. So if we looked at just mortgage applications, I think, a lot of players in that market have shut down operations or dramatically reduced staff because there effectively is no refinance market at this point. It's just new home financing. But if you look at prices, Case-Shiller shows about a 0.5% decrease in their seasonally adjusted index. It's the 5th consecutive monthly decline. If you look at the FHFA, they came out and showed that home prices fell by 0.1%. And an economist at FHFA says that, mortgage interest rates have suppressed demand, but low inventory of available homes for sale have helped maintain relatively flat prices. So we'll see how long that continues to last. If you look at some output created from Goldman this week, they are actually forecasting, that 4 U.S. cities are expected to have a decline in housing prices of more than 25%, which is, territory that hasn't been seen since the housing collapse in 2008. So in some commentary to their clients, they effectively said home prices in San Jose, Austin, Phoenix, and San Diego are going to have that, boom to bust 25% or greater price decline. A few other markets that won't escape the pain, according to Goldman, include Tampa, Dallas, Denver, Vegas, San Francisco, Portland, and Seattle, with their predictions being that home prices will decline 10% or more. And then, kind of contradictory to those individual markets, they say the overall national housing price correction is going to be pretty small. So they don't foresee widespread foreclosures like we saw in the Great Recession. So, interesting commentary from them. I can tell you in the market here, we actually have seen a slight uptick in foreclosure activity. It's usually a precursor to some of the commercial activity. So in one of our, Tuesday morning updates internally, we had talked about some of the bankruptcy filings here in the Texas market being up, with real estate being a large component of that. So it'll be interesting to see how this plays out. 30-year interest rates on mortgages fell for the fourth straight week. And then just rounding out the housing update here, Meritage Homes, which closed about $2 billion in Q4 revenue, which was a 29% increase from the same period last year. Kind of a mixed bag here. Orders are down 46% in the fourth quarter year over year, and their cancellation rate was about 39% this quarter, which was not the high water mark. We talked about another builder a few weeks ago that was over 60%. But what's interesting here is that said they proactively and aggressively went through their new construction pipeline and basically, fettered out the folks that were not committed to buying. So they kind of intentionally rooted out the ones that were going to cancel so that they could be proactive in repricing those houses and getting them sold. So an interesting strategy, from them, but hopefully one that turns out positive. So I know you wanted to cover a few more bullets, but I wanted to give the general thoughts on the Fed and the housing update.
Yeah, I think those were great insights. From a very macro level, it does feel like not only does the data indicate that inflation is cooling off, it just feels that way too, right? Gas prices well below their peak. You hear anecdotal evidence of rent increases at multifamily properties declining. You hear stories of offices being sold at discounts to where they were 6 months ago. Certainly home prices have leveled off, if not already dipped in certain areas. So the feel of the economy is that we have slowed down, and that, maybe more beneficial news will be forthcoming on the inflation front. But a couple of other things I wanted to touch upon today, some of which is just kind of confusing to me, and other things which are a little bit just some breaking news that we saw in the last hour. On the confusing side, one of the real enigmas for me is this job story. And the job story is a big part of what the Fed is looking at when they determine when is the time to stop raising rates, right? They want to see wage growth level off, and they want to see, even if they don't want to verbalize it as such, they want to see an uptick in inflation. What we saw this week was really confusing, right? We saw an ADP jobs report that was quite dismal. It was about half the jobs created than what was expected. On the other hand, we saw the JOLTS number, which is the job openings, about 10% higher than what people were expecting. There's an enormous amount of jobs out there, right? These layoffs have yet to impact the availability of jobs, and therefore the shortage of labor, which is the kind of thing that drives wages higher. And the other enigma was, today's first-time jobless claims, right? 180,000, that's got to be the lowest number in years, right? So on the one hand, you have ADP, which is incredibly bearish, right? Which says we're slowing down real fast. And then on the other side, you have two pieces of data which say, we're still running at breakneck speed on the employment side. So maybe tomorrow's jobs number will give us more clarity, but who knows? It could give us more confusion.
Yeah, I think it's interesting. You mentioned the job opening number. Looks like it hit a 5-month high here of 11 million in December, which was up from about 10.4 million in November. And then just some, more corporate announcements. FedEx said on Wednesday they're going to cut its officer and director ranks by more than 10%. And again, they're using, broad cost reduction efforts to reduce staffing levels. PayPal said they're going to, reorg. They're going to cut 7% of its workforce, or about 2,000 employees. Rivian, the electric vehicle manufacturer, is going to cut 6% of its assembly line workers. The layoffs and the job cuts continue to happen. I think even with Meta, I know we're going to talk a little bit about earnings here, but Zuckerberg said that they are going to continue to look at creating efficiencies with downsizing office space and, potentially even more layoffs. So it's interesting, but I took a step back last week. I was on a presentation, and some of the other people on the panel with me were saying, sure, these layoffs make headlines and we've all followed them. But if you go back and look at the hiring ramp up for each of these firms over the last 2 years, it barely puts a dent in it. Like they hired, 20x what they're laying off or whatever. So, I'm with you, man. If some of the stuff is a little confusing in the sense of like mixed signals, we think it's going one way, and 2 weeks later, somebody makes an announcement that maybe doesn't jive with what we thought was going to happen. So interesting times for sure.
Yeah, we want to get to some breaking commercial real estate news shortly, but I'll end this segment with, I'm looking at the tickers right now at big day, of course, for tech earnings. All the firms that I'm going to name have already announced big corporate layoffs and or significant reduction in office space. So I think it's worthwhile to see how they did. I think on the clarity side, it doesn't give us a lot of clarity. I think it was a very, very mixed bag. On the market reaction side, it could be a situation where today's results take a little bit of wind out of the sails of those that were heavy beta the last couple of days. So yesterday, of course, Facebook beat handily. Their stock was up 25%. That had a lot to do with the NASDAQ at one point being up 4% today. In the last 20 minutes or so, Apple appears to have missed badly. Amazon appears to have beaten by some degree. Google came in and also missed, just like Apple. The reaction is kind of uniform. The stock prices of all these entities down about 3 or 4% right now. And we've said this before, when stocks lag, CEOs and CFOs get nervous and they talk about more cutbacks and trimming spending. And this was decidedly, in the last half an hour, a mixed bag, with Apple probably leading the way in terms of the biggest disappointment.
All right, let's move on to what I'm going to call the first podcast trading alert. I think we probably need some appropriate music for some breaking news that we have in the office sector regarding RXR.
Yes, to put this in perspective, Martha's first of its kind trading alert that we're going to be talking about. We're recording this about 5 o'clock on Thursday. And for those that are listening, graveyard shift, Haley normally posts our podcast to the world at about 11 o'clock at night. So if you're hearing this for the first time at 11 o'clock at night and you're a Trepp client, you will have seen a trading alert around the same time, which talks about this particular issue. I thought this was really, really newsworthy. The story was broken by the Financial Times. If you can get that, it's a great article. It's also on The Real Deal. The story is that Scott Rexler of RXR, a big property owner headquartered on Long Island, has announced this week that the firm plans to give back the keys to the bank on 10% of its portfolio. For those that don't know, a huge presence in the New York City tri-state area, a lot in Midtown Manhattan, but not exclusively Midtown Manhattan, properties in Stamford, in Baltimore, New Rochelle and Westchester. I think they have some Jersey properties too, Long Island. They are going to be looking to give back 10% of their properties. We have a list of all their properties, which we will be sharing. Not all of those are in CMBS, but there are a significant number of high balance loans that have exposure to RXR/Rexler that people should really keep their eyes on going forward. The really alarming remark, an example of just extraordinary honesty, was Scott Rexler said some of his properties are a Kodak in an iPhone camera world. I'm paraphrasing that, but really indications of the fact that his properties are no longer relevant in the post-pandemic world, and it's time to cut his losses and give some back. Now, some are really strong performers, high DSCR stuff. will probably be unlikely candidates to be given back. 230 Park, 237 Park are some of the bigger ones. You'll see that on our list later. He shares a property through some of his funds with SL Green Worldwide Plaza on Manhattan's West Side. I think when you have a partner, you can't unilaterally give things back. So that one's probably safe too. What might be more concerning are some of the assets on Long Island, Uniondale, Melville, and so forth that might be candidates to be given back. And in some cases, those back loans of 50, 100 million, 100 million plus. And we're going to get that data out to you.
I think this is kind of one of those moments where you have somebody very highly invested in the market, active player, has the connections. When they come out and say that 10% of their portfolio is going back, this is maybe the proverbial, shoe that drops. And so we've been talking about office distress. We've been talking about, the challenges with adaptive reuse. We've been talking about this economic and external obsolescence that a lot of these buildings face. And maybe this is, kind of the beginning of the end of some of those, where I'm sure if this actually takes place and we find out what properties are going to come back, there are going to be several other developers that are in a very similar position that we might start seeing similar transactions, going down. So it'll be interesting to see how this reverberates, from a lender's perspective. Does this put you on an even higher alert to go through your portfolio and see if you have buildings similar to these that could be potential candidates to come back? If you're on the acquisition side, is this the moment you've been waiting for to go and buy some of these properties and hopefully, give them a new life in the marketplace? So I definitely think this is very newsworthy. The trading alert will be very helpful to give people some context on this. But I think, for us, it's kind of just the tip of the iceberg. There's a lot more that we're going to have to find out over the coming days and weeks in terms of, is this just one developer in their portfolio, or is this something that's more systemic that we're going to see across the marketplace?
Yeah, I think if you were to, I think it's somewhat seismic right now, the fact that they're giving back 10%, even when we don't know what they're giving back. I think it would be, an 8.5 on the Richter scale if it turns out to be something like a 237 Park, and, I think that's one that you really look at carefully, right? This was securitized in 2017. The loan size is about 600 million. If I'm not mistaken, they have a really big lease coming due in 2025. I'm sorry, they got JP Morgan there, which we already know is building its own headquarters. If that were to be, a give back, I think that would be really quite seismic. I know Haley, our producer, is from near one of the properties in Melville, New York. Maybe you could send your brother Clinton over to see what the property condition is. Is it A quality, B quality? See if the parking lot's full. Think you could pull that off, Haley?
He's at college right now, or else I think he would, but my grandma does live in Melville, so if we give her a really descriptive list of what we need, maybe she could go map that out for us.
There you go. On the way to the casino there, Jake's 57. On the way back, she could see how the parking lot looks at, I think it's on the service road of the LIE, if I'm not mistaken, the Rexler properties out there. So we'll have to see how that goes. But there were some other stories this week that were somewhat of a piece to this. Lonnie, you want to walk us through the redemptions story?
Yeah, so if our listeners thought that the Blackstone stuff had been resolved with the University of California, commitment, they're going to be a little disappointed, because it seems like Blackstone's in the news again. They had to halt withdrawals from their BREIT again, hitting redemption limits this last month. Additionally, one of their other funds, the Blackstone Property Partners, which this is a fund that's a little bit different in the sense that it doesn't target high net worth individuals. This is one that's for larger institutions, pension funds, endowments, et cetera. It's also facing increased redemption requests. Reporting says somewhere around 7% of the $73 billion net asset value fund. And so I think it'll be interesting to see, how this plays out. I mean, we felt like maybe things had stabilized. Them getting the commitment from the University of California, showed some solidarity in the marketplace, that there was still viability here, and that maybe there's a little overreaction from the individuals making the redemption request. This would actually maybe beg some more questions. So I think, and we've talked about this, Manus and Martha, on the pod, like if Blackstone's dealing with this, others are dealing with this as well in the space. And, it really just kind of begs the question. And I think it ties into the RXR story of what's the value? I mean, like that's the problem is nobody really knows what the asset value on some of these individual buildings and then rolled up to the fund level truly is. And I don't know that we have any more clarity today than we maybe had 6 weeks ago, but I think we're going to be forced, or they're going to be forced to expedite getting an answer to that question. There's going to have to be more real-time mark to market. And I think Martha, maybe you or Manus, we're going to have some commentary around Vornado and some of these other funds that, you know, have started doing some of that mark to market or write down based on information that they have.
Yeah, I'll let Martha get into Vornado in just a minute, but I just wanted to point out something, remind people of something I think you said, Lonnie, maybe 2 months ago, 3 months ago. I can't remember the property that we were talking about at the time, but you made the remark that sometimes these givebacks that result in the bank taking back a property and then selling it, and that sale price being a sizable discount, that can reverberate to the entire market, right? That changes your entire cap rate outlook, price per square foot, valuation of similar properties in the same neighborhood. And I think that when you see stories like RXR or in your case, Breet, you know, if they're active sellers of properties to manage these redemptions, you know, that has the potential to start being a self-reinforcing downward spiral. How's that for a combination of words? Self-reinforcing downward spiral, where each property you sell that's somewhat illiquid and a little bit dented resets the market slightly lower. And that makes the second property that sells after that a little lower, and the one after that a little bit lower. And it's kind of like a self-fulfilling prophecy that sales keep begetting more lower priced sales.
Yeah, we see it on the upside all the time. I mean, you look at these folks coming into certain markets and every subsequent sale is for a couple $1,000s a unit more, a couple $100 a square foot more. And so there's no difference on the downside. I think what we're hoping, or what the market should be hoping for, is that, you know, you quickly get to that bottom. And, you know, and I think that's where it'll be really interesting because, you know, we have NMHC this last week. I've seen some commentary coming from the conference that there's a lot of dry powder. There's a lot of people looking for deals. Just the bid-ask spread, like we've talked about, is still too far apart. But people are hopeful that they can get deals, you know, when this kind of slowdown starts to happen. So, you know, I think to your point, Manus, if we can get to a bottom quickly, then maybe you stop that continual, you know, funnel down. But if transaction volume is still slow and each subsequent sale is a little bit less, that's what happened in the GFC. Like we peaked out on delinquency something like 3 years later because there was a lack of liquidity and the bottom never came. So it'll be interesting to see what happens here.
And while it seems we're on a bit of a crab train here, we're going to talk about the Vornado story. Vornado Realty Trust has written down the value of its real estate portfolio by $600 million. And about 80% of the write down comes from Midtown properties. They're a mix of retail and office. Not the best story to hear.
I think Vornado kind of sounds like Manus's tornado that he was just talking about. So not great news. I mean, for each one of these, though, there's still, you know, green shoots that we're seeing every day in the marketplace. So I don't want the listeners to think that this is all doom and gloom. I mean, this is just, you know, what we've been talking about starting to play out in the market. And I think it's expected. So as long as, you know, not every fund comes out or every REIT comes out and says they're writing things down across the US, at least at this point, it seems like fairly geographically similar locations, similar property types, and things that I think all of us that study the market daily would expect to see. We're just actually starting to see these things play out instead of them just being talked about.
And while we've been chewing on some negative news, let's move on to something that defies the doom and gloom. And that, my friends, is the delinquency rate.
Yes, we put this out a couple of days ago. If you're not on our blog list, you wouldn't have seen it, but this is not something we hold behind a paywall for clients only. We do share this number for the entire market. Anybody that is on our blog list gets this data. And the rate fell this month. It is now back below 3%. For those that need the historical refresher, after going through the initial shock waves of COVID, We saw about a year and a half, 2 years of consistent dips in the delinquency rate. We bottomed out 4 months ago at 2.92%. We started to see things creep up really slightly in October, November, December, just by fractions of percentages, but it did creep back up above 3%. But this month, the rate fell back below 3% again, kind of defying the expectations, maybe even doom and gloom that we got out of Miami a month ago. The narrative down there was that delinquencies have nowhere to go but up. Maturing loans that cannot be refinanced will be the source of that uptick, and there's not much we can do about it. I like to say that never does 1 month's data make a trend, so this might be one downward blip, but it is a positive sign in an otherwise unclear environment for commercial real estate. Going through some of the numbers, slight downtick in industrial. Industrial just remains almost blemish-free. Only 0.4% of industrial loans are delinquent as of January. Lodging, 4.4%, almost unchanged. Big dip in multifamily. Some of those loans that had gone delinquent, big loans that were having trouble getting extensions, one or two of those cured. An uptick in office, not surprising. Office ticked up 25 basis points. It's now approaching 2%, still quite low by historical standards. And retail, it's the laggard, but it saw another improvement this month. The rate dropped almost 40 basis points. It's about 6.5%. That drop was helped by a cure in the delinquency status of the Palisades Mall in Rockland County in New York.
I'm excited that the number is as low as it is, but I'm kind of surprised that it stayed this low. I mean, the market has been resilient. And if you look, we parse data through the system, and we've talked about it some on the digging through the data segment of properties with debt service less than 1, and there's a sizable amount of them, but they are still making the mortgage payment. So it just speaks to the strength and resiliency, at least the perceived strength and resiliency from operators where the property is not covering the mortgage, that they're still covering it. And so it's great to see this number go down. For how long? I think that's the question. In our predictions, I think both of us, and Martha included, we were all expecting this number at some point in 23 to tick up and be some multiple of where it's at. But looks like this month is another great month.
Yeah, it's like those years when you don't expect your team to win the Super Bowl and you don't like to be wrong, but when they do, you're ecstatic, right? This is one of those moments where pretty ecstatic that things went down, even though I was predicting they'd go up, to your point, Lonnie.
Is your team in the Super Bowl running?
No, my team is the Giants. I picked them to win the Super Bowl every year since 1972, and I'll pick them again next year. But I was pleasantly surprised. They had a decent year this year. It was bested my very low expectations.
I'm going to have to admit to being an Eagles fan, and I'll debate that later. And before we continue with some more office news, let's cover Bed Bath & Beyond, which obviously continues in the news on bankruptcy discussions. It's closing another 87 stores.
So now that is the third major announcement of store closings over the last 4 months or so. I think they started in September. They had said back then they were going to target 150 stores. They're now past 150 already. I think the first number was 50 that they announced. Then it was another 62. This week was 87 more. So, we're kind of above the number that they were originally targeting by a substantial amount. I doubt that they're done. I think their ability to get through this without going through a bankruptcy proceeding is unlikely. And I think if they go down that path, you will see a lot more store closings. I think if you're a landlord, if you have a Bed Bath & Beyond with a near-term lease expiration, you should probably consider that as likely to be X'd out unless sales are really, really high. I think if you are a landlord with Bed Bath & Beyond, even on a long-term lease, you should probably hedge your bets. If it's a low performer, it's a good chance that it's going to be rejected in bankruptcy. And then more broadly, for those that are not in the weeds of this, Bed Bath & Beyond is not the only name in that franchise that you have to worry about. The organization came out this week and said they're closing all of their Harmon stores. Harmons tend to be, I guess you would say, cosmetic stores, maybe something like that.
That's exactly what they are.
That's what they are. A lot of times they're right next to Bed Bath and Beyond. They're paired together. All of those will be closing. And then the last thing, which is a little bit harder to get your arms around, is they also own Bye Bye Baby, which I think has a lot of residual value. I think people have been circling that, hoping that they could pick up that franchise from Bed Bath and Beyond and operate it separately. I think Sycamore might have been a company that was looking at that. But even this week, the firm announced they were closing a couple of Bye Bye Babies. So even that franchise may not be completely immune from periodic store closing headlines.
Is this when you take the Bed Bath and Beyond coupon and make it like an NFT? Like, is that still a thing? Could we take some of those Bye Bye Baby, Bed Bath and Beyond and make some money on those, Manus?
Well, I always found these Bed Bath and Beyond. I've been in there a couple times. It takes about 4 minutes to go through them. Like, they just don't have anything. I don't like to kick a franchise when they're down, but they don't have much in the way of things that I'm looking for. I definitely use soap, but I don't buy new sheets and pillow covers very often. I don't even know what body wash is used for, to be honest. I see it and I'm like, how does that differ from soap? But, for me, instead of the NFT, I'd probably stack a few of those together and level out a table, the kind that's kind of rocking back and forth, one leg's shorter than the other. For those that count on us for this type of thing, we did produce a Loans in the Spotlight page, which captures the intersection between CMBS loans and the most recent list of store closings for Bed Bath & Beyond, Harmon, and Bye Bye Baby. So if I'm not mistaken, we now have 3 recent ones of this, one for the 50 store closing, one for the 62, and one for the 87. So you don't have to replicate your work if you've already looked at the first 2 lists. And I think at some point, Steve Bushbaum in our group made a list of all of the Bed Bath & Beyond exposure in CMBS, which is also on our website for those that can't get enough of BB&B.
Okay, let's move on to the office segment where we've got a number of stories, and then we'll do some other stories that we have in multifamily and retail.
Yeah, I may not give all the details of these because we are running a little bit late right now, but I'll run through them quickly. If you need more color, please reach out. This was a great green shoot. This story came from Crane's Chicago Business. Winston and Strawn, the law firm in Chicago, is going to take 150,000 square feet at 300 North LaSalle. This is a really important story for that part of the market. The property backs a 900,000 square foot office in downtown Chicago. It's one of our big loans to watch in 2023 and 2024. Kirkland and Ellis is the dominant tenant with 600,000 square feet. They've already announced that they will be leaving and terminating their lease. Boston Consulting Group has 150,000 square feet there too, and they too have said that they're leaving. So the fact that the owners of 300 North LaSalle are lining up Winston and Strawn, and to be clear, they're on the 5-yard line from what I hear, that would be a game changer for that particular property. Good news there. Another green shoot. This comes from Rebecca Baird Remba. CBS will be keeping its studios at 555 West 57th Street. They have renewed for 200,000 square feet at that property, downsizing only slightly, only by about 5,000 square feet. In addition, at the same property, Greater New York Hospital Association has renewed for 60,000 square feet. Great story there. In St. Louis, Gloria Lloyd, St. Louis Business Journal, revealed that NISA Investments is taking 95,000 square feet at Centene Plaza in Clayton. That property we referred to last week when we said that Equifax would be taking space in that property. Now NISA Investments is also taking property there, almost 100,000 square feet, and the building is now 100% accounted for under that new construction.
Yeah, I just think it's a great story in the St. Louis Business Journal. I mean, this is another really great thing. Now we talked about this building a couple of weeks ago, as you mentioned, and maybe this is kind of, super high-end Class A relative to some of the other stock there in the market, but still a great green shoot for St. Louis. And the other stories, I think it just goes to what we said earlier. Like for every negative story, it seems that there's a positive story in the marketplace as well. So great to see some of these, leases being renewed, 10-year terms, like, what we would consider typical office transactions. So it's good to see.
I always find that when I start talking faster, I make other people on the podcast also start talking faster. So I'd like to next week hook up an EKG to Lonnie and see when I start running through these green shoots and crabgrass really fast, if it's impacting his pulse rate. I get this sense that, it's a little bit of an epidemic. All right, here we go to the trading alerts and crabgrass. This first one came from several news organizations. The Charlotte Observer called it a jolting story for the Charlotte commercial real estate market. Wells Fargo will be vacating one Wells Fargo Center and two Wells Fargo Center in Charlotte. One Wells Fargo backs a $160 million loan. The loan was already on our watch list that we put out 2 weeks ago of office loans that we're concerned about. A couple of years ago, Wells Fargo downsized from 700,000 square feet to 265,000 square feet. Now they're giving up that 265 entirely. They're consolidating their offices elsewhere, and that will put several 100,000 square feet back on the Charlotte market. I believe the Charlotte lease at 301 South College goes until 2030, if I'm not mistaken, 2032. So not a credit risk immediately, but something to watch, both because the loan matures soon and DSCR is already sagging. Elsewhere, HubSpot announced a big lease consolidation charge, astronomical. They're taking a charge of between $50 and $74 million to reflect the fact that they have found some of their space to be obsolete for them. This is an accounting requirement. Firms do this all the time where they have to market their lease. If they're not going to use it and they think it's out of the money, they have to take a charge. That's what's happening here. The big loan to watch from our perspective is the $107 million Davenport that's in Cambridge. HubSpot is the sole tenant there on a lease that runs until 2027. Keep an eye on that. It makes up 10% of a 2017 deal. Back to Chicago, Danny Ecker of Cranes, Tyson Foods putting up 235,000 square feet for sublease at 400 South Jefferson. In the Denver Business Journal, Kate Tracy, Vail Resorts looking to put 75,000 square feet on the market in Broomfield. In San Francisco, Callista Media, this story comes from Laura Waxman, 80,000 square feet at 1955 Broadway in Oakland. Block, that is Jack Dorsey's firm, is on the hook for that lease, but they had subleased it to Callisto. Callisto is now saying we're not interested anymore, giving it back. Lastly, on the crabgrass part, Invesco selling a building in Arlington, Virginia for $30 million less than it paid for it in 2014. The property is 1776 Wilson Boulevard. Invesco is selling the property for $60 million. It bought the property in 2014 for $90 million. So lots of crabgrass. I'll get your reactions, and then I'll close it out with one more mixed green before we move on to multifamily.
So that was we're going to have to start calling that segment Rapid Fire with Manus. And I think maybe we play the Rocky theme song in the background when you go through those things so quickly. And don't kid yourself, Manus. I'm down here pedaling my little bike under the desk, so I'm always ready, regardless of the pace. But we did have another interesting story here that I wanted to cover, and it's really nice. Martha put this one in. It's and I think it's titled appropriately. One person's crab is another person's green shoot. This comes from The Real Deal. Dermody Properties acquired Metro Corporate Center, about a 400,000 square foot office in California. That was purchased by a Reno, Nevada investor. They actually bought this property from Amazon, which had acquired it, a couple of years ago in 21 for about $123 million. I think what's interesting here is this was part of Amazon's strategy to basically divest of, what they considered excess leases or buildings, and potentially creates opportunity for folks to come in and buy those assets at some discount relative to what Amazon had in a basis perspective. So, this was a property built in 82. It's about 47 miles south of San Francisco. They're effectively going to convert the property into a 490,000 square foot industrial building, and work was expected to start on it in July. So, I don't know exactly what the end use of this will be, for the new acquirer, if they're going to continue with that plan or not. But I think this is something where Amazon lets go, somebody else comes into the market. The price wasn't released at this point, but there was a source or whisper that said they definitely took a loss, Amazon did, on the property. So interesting footnote there, and something to keep an eye on across Amazon's portfolio going forward.
I'm itching to find out that price. I really want to see what the discount was, because that would be really eye-opening, right? If it's 10%, it's one thing. If it's 30%, something quite different for that market. So if you have that caller and you want to reach out to us anonymously, if you have some insights, we'd love to know. I guess we can give a Trepp t-shirt in response to anybody that wants to hit that bid. We are incredibly generous with those TreppWire t-shirts.
We're releasing a report. I believe it was released early this week. Multifamily markets to watch. I thought it was interesting, Lonnie, when I was looking at the list of cities that we're going to keep an eye on and how it correlated with some of the cities that you mentioned at the beginning of the podcast that had home prices dropping.
Yeah, I think there's definitely a correlation between home prices and some of the impacts to multifamily. I mean, if you look at it, it seems like in today's high interest rate environment that people would maybe be buying less and renting more. But if you look at rent growth over the last several years in some of these markets, like it's become really unaffordable for renters in multifamily, especially a lot of the new development has been super high end Class A. And so, affordability is becoming a concern. I think there's even more downstream implications in the sense that we've seen dramatic increases in some of the mobile home park, RV park type of financing and strategies there. But to get back to the cities, Goldman had released their stuff saying, markets that they expect 25% value decline, and then some that were 10%. If you look at some of our cities here on the multifamily side, Seattle, San Francisco, Chicago, Minneapolis, these are pretty large cities that have rounded out kind of the top 5 of our multifamily markets to watch. We've had a couple of good green shoots on the office sector for St. Louis. But unfortunately for St. Louis on the multi side, they took the #1 ranking as, the market most to watch. Now, just to give our listeners some context, if you haven't received a copy of this report, you can email us at podcast@trepp.com and we'll send it to you. We basically looked at 4 different metrics in the analysis. So what we looked at were weighted average trailing 12-month occupancy, the percentage of properties with debt service coverage of less than 1, weighted average net cash flow growth across all the properties within those MSAs, and then the percentage of originations that occurred in the first 9 months of 22 relative to all other outstanding loans in the MSA. And we tried to come up with, an objective ranking of markets that we think, maybe aren't in distress today, but have the makings to show potential distress in the near future.
Okay, pivoting to retail, we have a couple of stories we were going to cover, including one quick hit research piece that we're going to be putting out. As a property type, grocery anchored retail scored its second consecutive record year in 22 with $14.7 billion in total transaction volume, which is an increase of nearly 16% over 21, according to JLL's U.S. Grocery Tracker report.
We've come full circle on grocery. Before the pandemic, people were talking about food deserts, that we were over-grocered. We had seen some corporate bankruptcies even. I think it's Marsh, if I'm not mistaken, in the upper Midwest, Southeastern grocers, places like Piggly Wiggly, if I'm not mistaken, Bilo, big store closing announcements and so forth. And the narrative in 2018 and 2019 was that we're going to see more consolidation, right? More disappearing of grocery stores. And the pandemic really stopped that in its tracks and has turned it around completely. It's now viewed as a really reliable, dependable, recession-proof, pandemic-proof asset. And so I guess the research report doesn't really surprise me.
Yeah, I would echo the same sentiment as Manus. It seems like this sector's really come out of the pandemic strong, and this indicates that, it's here to stay. We did put some stuff on the Trepp loan product that we have, where we look at the Albertsons Kroger merger and some of the impacts there. So if you haven't checked that out, it'd be a great time to look at that. But, I'm bullish on grocery anchored shopping centers going forward. It seems it's a nice mix of what consumers want and provides a really valuable service to the local communities in which they're located at. Yeah, so just, kind of to dig a little deeper, beyond just saying like, sure, this asset class looks great or this property sector looks great. If we want to dig a little bit deeper, we can look at the Whole Food stores. So centers that are anchored by Whole Foods had the most aggressive pricing, typically transacting at about a 4.9% cap rate. That was followed by anchors, Sprouts and Publix, which traded about 80 basis points wider than the 4.9 for the Whole Foods, which is interesting. Whole Foods, they have a very specific clientele. And so I think, institutional capital chasing yield maybe feels better about Whole Foods than they do some of these other large grocery chains. However, it looks like fourth quarter 22 foot traffic for Whole Foods decreased about 8%. And, kind of the benefit of having that higher price consumer when times are good, maybe there's some downward pressure when times start to, inflation kicks in, the market slows down. So based on, those higher costs, it seems like there's been a correlation to less foot traffic in those Whole Food stores. So our internal analyst, Emily Yu, she took a deeper dive look at the Whole Foods tenant in our Trepp data. We're currently tracking about 42 loans across 43 properties with outstanding balance of about 1.7 billion, where Whole Foods is the tenant. And we have two particular loans where that's worth highlighting with Whole Foods as a tenant: Skyline Town Center, which is about a 57,000 square foot retail shopping center in Asheville, North Carolina, and Columbus Square portfolio, which is about a 500,000 square foot mixed use property, which has 5 units of Manhattan's Upper West Side with about 276,000 square foot of retail space. Whole Foods operations make up about 24% of that property. So reach out if you have any additional questions or follow-up. We'll be happy to share what our other insights are concerning these stories.
And turning to some programming notes, the benchmarking webinar is next Tuesday, February 7th. We mentioned that last week. We've got a number of lending and banking experts talking about portfolio lending and benchmarking and analyzing loan performance. The NII conference, which is February 6th, we've got a team that's going to be there in Vegas, and I think Lonnie is going to be there speaking on State of the Office market panel. So look us up there. And the MBA conference, February 12th, our team will be attending in San Diego, and Lonnie's going to be there too. You have got a lot of travel in your future.
Yeah, I'm going to be back to my home address of, seat 12A, American Airlines. And so we'll be spending a lot of time in the air, but looking forward to having an opportunity to talk at these panels and share some of the data and insights that we're tracking on a daily basis.
And shout outs. A lot of people were reaching out for our loan spreads information. Cooper H, and he wanted to say a quick thanks for the podcast. Extremely informational and timely for my teammates, given how active we are in secondary CMBS trading. So always learn something new and appreciate the granularity of CRE data that we discuss. Kent T, Peter L, Chris W, Tyler S, Dylan K, Oz was interested in some of the survey data we were talking about and wanted to find out more. Ann L reached out for comments on what's going on from our perspective on AI and CRE. So we'll give her a response on that. Christine H on LinkedIn loves our analytics and reports and subscribe to our newsletter and a bunch of other stuff. So thanks. Phil V on Twitter, been a big fan of the podcast. Callie A is a secret loyal listener, but she told us she loves listening every Friday and learning more about CRE through the pod. Dan M, who's a perennial fan, wants to give us a shout out, but also to our own Tommy C. He says his level of service is unmatched. I'm sure Tommy will appreciate that. And guys, today is Groundhog Day, and our favorite meteorological gopher, Punxsutawney Phil saw his shadow when he emerged from his little hideaway in western Pennsylvania. So you know what that means? 6 more weeks of winter.
6 more weeks of winter. How reliable is that? I mean, have we done any correlation between that critter and reality? Is it, do I have to worry about this? You know, I know it's 5 degrees in New York this week and it sounds pretty awful. I don't know. What do you guys think?
I think we need to start a groundhog property price index. And so we're working on that. Maybe next year at this time, we'll have something to share with you guys.
So Lonnie's going to go back. He's going to check the data between whether this critter saw his shadow and see what property prices, if they appreciated or depreciated or declined over the next 12 months. I think that's a worthy endeavor, Lonnie. When you're in seat 12A on that Southwestern Airlines flight, you should really dig into that one.
We'll see what I can do on that. I mean, I'm scared to Google it because it probably already exists, unfortunately.
Somebody did that. So with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send it to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.